Manishi Raychaudhuri is well in the show with us. Manishi, hi, good morning. Good to have you on the show. Happy Diwali and a Happy New Year.
Thank you very much, and same to you, same to our viewers. Wish all of them a very happy Diwali and a Happy New Year.
It's turning out to be a happy one for sure, Manishi. We were just mesmerized by the FII buy figure, 35,000 crore rupees just month to date so far. What explains this bullishness?
It's a combination of several things, but I think at the center of this bullishness is a general positive sentiment about the emerging markets in general. I think on this same channel in in a conversation with you, made the comment about a month or so ago that in the entire Asian universe, there are only two countries that have obtained positive FII flows in 2020, and they're China and India. Now that's also beginning to change. Over the last 1 to 1.5 months, we are seeing some of the historical laggards like the North Asian markets, they're also beginning to get new foreign inflows. So I think there is a broad-based positive sentiment about the emerging markets. It has arisen, number one, because the US elections are now behind us. There's a possibility that even the global geopolitics and the rhetoric surrounding it would become a little less strident. Second, the news flow about vaccines, and we have had two of them in close succession. That has clearly given rise to optimism about a synchronized global economic recovery, possibly starting sometime in 2021. And these are clearly strong positive tailwinds. We're also seeing the US dollar depreciate against most currencies of the world, but particularly against the emerging market currencies. And that historically has been a surefire tailwind as far as emerging equity performance is concerned. So all these things have, kind of come about together. And it's no surprise that India is getting its fair share of the foreign inflows.
Manishi, is pharma as a sector looking priced to perfection, or do you still believe there are opportunities there in the near term purely?
In the near term, if one looks at these, the sectors which are relatively uncorrelated with the domestic economy, like pharma and IT, both have done well, no doubt. But as far as the headline valuations go, we would think pharma is possibly more fully valued than IT. And I'm drawing this comparison because, the comparison between these sectors, which are relatively uncorrelated with the domestic economy, inevitably rises. We have a representation of IT service stocks, particularly the frontline stocks in our portfolio, but not the pharmaceuticals.
Sure. Manishi, let's talk about cyclicals then, and that's a segment of the market that everyone's now eyeing. Considering that it's also linked to the recovery, and we're hearing so much positive news around the vaccine, which possibly is going to get things moving or accelerate things moving in the new year. What's the kind of expectation you have, from that part of the market and the kind of bounce back that we can possibly see?
We have incrementally turned positive on the cyclicals all across Asia. We have added more cyclicals to the portfolio. We have trimmed down our exposure on the growth sectors, particularly the TMT side. In India, and it kind of mirrors our strategy across the rest of Asia, we have a feet in two boats kind of strategy. We have a significant representation of both the cyclicals, and in case of India, that's predominantly the financials, which we are playing both through the private banks and the insurance companies, also some of the housing finance companies, and some of the consumer discretionaries. We have added in small bits and pieces some of the auto names, the leading frontline auto names, which are gaining market share. So, I think, it's a good time to dip into those cyclicals which have underperformed this entire period over the last 7 to 8 months. But at the same time, one needs to be slightly cautious and be selective in that sphere, because this whole narrative about a vaccine tends to be volatile. In a sense, one could argue that it's not over till it's over, till we actually get a fully approved vaccine, which would be, which can be administered to the population in a timely manner. Expectation of a broad economic recovery on that basis may still turn out to be a bit premature. So, that is how we are playing it. Incrementally, we have turned more positive on the cyclicals. We haven't gone full throttle into them, however.
Fair enough. And within that as well, which would be, some of the, some of the names that you're looking at closely? Would it be some of the banks, for instance, or would it be industrials? Like, just take us through even within that what the breakup would be.
Right. So, as I mentioned, that as of now, our position in cyclicals, as far as India is concerned, is predominantly in the financials. That's private sector banks and insurance and the housing finance companies. I would also point out that some of the cyclicals are actually showing a significant degree of positive earnings inflection. Or in other words, over the last 1 to 1.5 years, their earnings estimates were consistently going down, but over the past 2 to 3 months, they're showing an uptick. And that's what we refer to when we talk about positive inflections. Earlier, this positive trend of earnings estimate revisions were visible only in TMT and healthcare. But now that has changed. We are seeing it happen in materials, we are seeing it happen in energy, in financials, and also in industrials. That said, I think the first round of recovery would possibly be in materials and financials. The industrials typically tend to be a late recoverer because, after all, the companies have to reach a certain level of capacity utilization with demand recovery. And then and only then they would think about expanding their capacities. So, and that's when industrials would begin to perform. So, we have at the back of our minds that kind of a sort of investment wheel, if you will. First with materials, financials, select consumer discretionaries, and later on with industrials.
All right. We just had the line drop, Manishi, so just pardon that slight delay. But let's take a look at some of the other elements that we're tracking as well. When it comes to sectoral play, sure, but what about a more broader base participation as well? Is that something you see happening as the markets move higher on from these levels? Because we've otherwise seen a very polarized play over the last year or so. Do you see that changing?
Well, I just now talked about financials, materials, but at the same time, I must point out that in our portfolio allocation, we are not forgetting the champions of yesterday, that's TMT either. So we have a significant exposure to the frontline IT stocks, and the last 2 result seasons have underscored that these stocks are not only beneficiaries of the COVID outbreak, but many of them are also securing pretty significant deal wins from the Western Hemisphere. So frontline IT companies, telecom service providers, the pure service providers, and the conglomerates, they also figure prominently in our India portfolio allocation. And we think that for the time being, they will likely continue to do well. Many of these have found additional avenues of cost reduction. In fact, we're seeing that during this COVID outbreak phase, companies all across the region have found novel ways of cost rationalization, and that's actually adding to their margins. So and we think that that's likely to continue. The TMT universe could turn out to be a beneficiary of that trend.
If TCS is trading at 25, 26 times, FY22, not FY23, Infosys early 20s, some would say that whatever constructive scenario which we are staring at, markets are saying, we know it.
Right. You have a point there. In fact, if one looks at the headline valuations of, let's say, Sensex or MSCI India, one would see that there's these price earnings in particular, not so much price to book, but price earnings are possibly about 2 to 3 standard deviations higher than the long-term average. But at the same time, there's a degree of polarization in valuations that we have seen. Unfortunately, some of the stocks that you just talked about, the IT services stocks, they're actually trading significantly above their long-term averages. Having said that, we believe that the positives in terms of the earnings momentum that they can potentially have as a consequence of the deal wins that I talked about, they're possibly not factored into the current earnings estimates at this point of time. So, in a sense, the recent uptick in earnings estimates that we're beginning to see now, I would expect that to continue for some time, which would mean that those valuations that you talked about, they may actually appear slightly lower than, the headline numbers, the way they appear today.
Manishi, I want to go back to that point because you are in a right place to tell us that why suddenly flows have come back to India. We are looking at 30,000 crore, about $4.5 billion, which have come only in the month of November. Is this just like a sugar rush? Or do you think India now is going to be a serious recipient and this is not a sugar rush, this is more like a new normal now?
Right. Very short-term flows over a 1 or 2 week period are difficult to explain or to predict. But if you look at this year, 2020, India has got a little more than $9 billion US dollars of fund flow from the FIIs. China, just through the northbound stock connect, has got a little more than double of that, somewhere close to 18 to 20 billion. India traditionally gets somewhere about 15 to 20 billion. If we look at the history over past 10 to 12 years, the highest ever was about 30 billion in calendar year 2010. So when you put this year's numbers in that perspective, it does not really appear something which is egregiously high. I would also point out that there is a hunt for yield that's going on across the world right now. Therefore, in a world where cost of capital has been beaten down to extremely low levels, countries like India, markets like India, which offer relatively higher growth over the longer term, they're bound to attract foreign investors' fascination. And this is exactly what we're seeing here. I would think that emerging markets in general, and the markets like India, Greater China in particular, they would continue to benefit from this phenomenon.
Sure. Manishi, while the US-China trade wars seem to be have faded into the background, at least for the moment, India over the weekend also we heard that they've decided to stay out of the RCEP as well, and that trade deal among some of the other South Asian nations. So how does some of this stack up in India's favor, given that they are trying to draw in some serious capital investment, from global majors here at this point of time?
Right. Well, India staying away from RCEP is not new news. I mean, India had made that decision in late 2019. It is again coming into focus only because the RCEP is being formally signed now. And therefore, it's in the news that 15 Asian countries are signing the RCEP. India is not one of them, but it's not a new development. And I think the reasons that the Indian policymakers had discussed when deciding not to enter the RCEP are actually quite valid, because India's FTA experience with other Southeast Asian nations, for example, they have not actually been too happy. Those FTAs have been signed all throughout the early 2000s, and the impact of those had only been to expand India's trade deficit with those nations. So I think, until and unless some of the concerns that India has are addressed, it's possibly, for the time being at least, it's been the right decision for India not to join a multilateral trade agreement. On the other hand, I'll point out that some of the domestic focused measures that have been announced recently, like increasing the production-linked incentive, the PLIs, for about 10 sectors, that has the potential to increase domestic manufacturing to a far more significant degree. So all these measures would take some time to play out. It's obviously not going to happen right now. But I think the focus on enhancing domestic manufacturing capabilities, it is something that gradually the investor base would come to notice.
Manishi, have a wonderful year ahead, and thank you for joining us.